Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management. With the market's recent volatility, we wanted to release a market commentary to discuss our perspective on what is going on today and what we expect to occur down the road. A lot's changing, and a lot will change in the next 6 months. So let's dive in. The stock market dropped 8.5% recently on fears of an upcoming recession. There's a number of reasons why those fears have been increased over the last couple of weeks. What we wanted to do during this video is dive into each of those different factors and explain a little bit more around why the market has changed their perspective. The first of which being the strength of the consumer in the United States. They've recently come under pressure. Why is that? Lately, there's been a lot of data that has indicated a less optimistic outlook for consumer spending as well as economic strength. Excess savings from the pandemic that was created by so much of that stimulus supported a lot of consumer spending in the past, but has recently significantly decreased. They're actually falling to their lowest level of the current cycle, as you can see by this chart. Consumer spending in the future is expected to moderate even further, given that these consumers no longer have that excess savings that they've had in the bank for quite a few years now. And on top of that, you have delinquency rates on different forms of debt, whether it be credit cards or auto loans, on the rise as well. Now, debt service, the ratio of what someone is paying towards debt on a monthly basis relative to their income, is still lower than before it was during the pandemic, or before the pandemic itself. However, signs are still indicating that consumer resources are being stretched at the moment. In the chart, what you can see by the blue line is the actual personal savings amount. The orange bars represent the excess savings that was generated during the pandemic and then drawn down over the course of the last few years to nearly a neutral level or no excess. When it comes to the market itself and the individual sectors of the market, we've seen a lot of change over the course of this year. At the start of the year, we saw a broad-based rally where a lot of companies within the S&P 500 were doing quite well. As the year went on, that leadership narrowed to just a few very large companies. The breadth of the market was declining. What happened in July was a sector rotation. This sector rotation can be explained by this chart right here. This chart breaks down the broad value leadership that occurred in the month of July, where we saw a rotation from growth sectors of the market to value-oriented sectors of the market. Real estate, utilities, and financials all led the charge during July, and even smaller cap companies within the Russell 1000 started to perform as well. In June, we received a better than expected CPI report, a measure of inflation, and there was growing belief that Trump would have a second term. Both of these things contributed to this rotation that occurred in July towards value-oriented stocks. On the other side of the market, you have fixed income. Bonds have not been the greatest of investments in recent years, and bond investors have had to remain extraordinarily patient as the stock market has really outperformed pretty much every bond investment out there. However, they may be getting some relief soon. As we approach the first interest rate cut expected to happen in September, bonds should begin to outperform right around this time. This next chart explores a little bit about how bonds tend to perform ahead of an interest rate cut and then afterwards as well. As you can tell, bonds tend to perform quite well ahead of the first interest rate cut, somewhere in line with 3 months ahead of time. If the Fed decides to make their first cut in September, we're right in the thick of that window right now in August. However, we've seen quite a bit of volatility in interest rates and therefore in the bond market as a result of the uncertainty around this upcoming recession or lack thereof. There's a lot of conflicting data out there around the trajectory of our economy. We'll have to see what happens. But we are optimistic that bond holders should see some relief in the next couple of months, if not the next year. Whenever the stock market experiences an extended run or an extended period of outsized performance, it's normal to expect volatility and some ups and downs. There's a lot of conflicting data out there around our economy and the market. Many believe a recession is on the horizon. Our base case expectation is that we shouldn't encounter a deep recession. However, many out there believe that to be the case and will continue to contribute to the ongoing debate about where we're headed. As we continue to position portfolios for the potential eventuality of many different outcomes, risk management is always top of mind as we work to protect and grow our client assets through the duration of their lives.